let's now take a look into the housing market. Certainly we talk about everything appreciating at the moment, that included, given we're seeing those prices go at the moment. Amidst, of course, a rental crisis there, given the shortage of housing. And that has led to talk about the need to change negative gearing as part of the answer to making houses more affordable. Let's take a deeper dive into that. Anthony Landahl joining us from Equilibria Finance. Anthony, good to see you. Thanks for joining us. Now, of course, negative gearing has come into sharper focus. Also talk about capital gains in housing, as clearly many people finding it more and more difficult to get into the broader market. First of all, just paint the picture of the scope, I guess, of this crisis we're seeing in the Australian housing market at the moment, particularly among renters, given that shortage.
Yeah, g'day Andrew, nice to be here, mate. Look, fundamentally, Australia's rental affordability is at a 17-year low, is what we've had reported in the recent data. We had 160,000 houses built last year, and we had 600,000 migrants come in. So this chronic housing shortfall is not going anywhere, and it's affecting both property prices as well as renting, with a lot of rental vacancies below the 1%. What we're seeing in terms of credit flows is we are seeing a shift. We're seeing more investor activity, up to about 32%, which was down from 30% in the December quarter 12 months ago. And we're also seeing owner-occupier activity has fallen by about the same amount, 2.5% or so. I think that's an interesting one, the owner-occupier activity, because we're seeing that affordability really bite amongst, say, first home buyers and other sectors of the market, where they're actually looking at rent vesting as an option. So they might be saying, we can't get into the market to buy a house, let's have a look at buying an investment in a different area to leverage into the market. So the rental crisis is real. Vacancy rates at record lows. Constructions of houses is not nearly keeping up with the demand that we have for new housing, but we are seeing a shift back to investors. And as you hinted at, we're seeing some murmurings in the hallways of government around capital gains tax changes, as well as negative gearing's being raised again in the context of our taxation system.
Okay, Anthony, let's focus then on negative gearing. We do know the benefits as far as investors are concerned. If you're making a loss, obviously there's the tax benefit if a property is negatively geared. How, though, does it impact the broader housing market?
Yeah, look, I think we've got to be cautious about just saying, look, negative gearing's only for the wealthy, or we should scrap it. Negative gearing does provide obviously a tax benefit for about 1 in 10 households only. So there's only about 1 in 10 investors who are claiming the deductions, the negative gearing benefit. Property is an asset class that a lot of Australians access as part of their wealth accumulation strategy. It's not just for the wealthy, as some may perceive it. You've got nurses, you've got doctors, you've got bus drivers, you've got plumbers, you've got a lot of people who use negative gearing and use the housing market as part of their overall wealth accumulation strategy, where they might be running the property at a cash flow loss, because their longer term focus generally for an investor is on the capital gains. So the perception it's just for the wealthy is not really correct. The other interesting factor is how much it might affect the budget overall if we removed, for example, negative gearing. The truth of that as well is that a lot of properties are only negatively geared for a couple of years. And obviously fluctuations in interest rates impact gearing. And as I noted before, only about 10% of properties that are invested are actually negatively geared. So we've got to really be careful about saying, let's throw that out. It's going to have a massive impact on the budget, or it's just for the wealthy, because the flip side of it is investors play a critical role in providing supply. There's a lot of mum and dad investors who use this tax benefit as part of their wealth accumulation strategy. And some recent examples in New Zealand where they removed negative gearing, or back in 1985 in Australia when they removed it for a short amount of time, was the actual effect was it actually increased rental prices, which is a problem we've already got with rental affordability at a 17-year low.
Would it, though, if it was removed, be a disincentive for investors? I mean, you talk about 1 in 10 investors perhaps taking advantage of it. Would it really affect supply in that sense, that less or fewer investors would get into the market? Mind you, it's more established homes that they've been investing in, would it not? And the problem is you actually need to build more homes.
Yeah, it's twofold really. One of the arguments is that if investors move out of the market, does that free up supply for first home buyers, for example? What we saw from the New Zealand example, which is the most recent, was that investor activity did initially drop off as investors had built that negative gearing benefit into their overall strategy. Over time, investors came back into the market, but what they did was they passed those costs back into the rental market. So it didn't really improve overall rental affordability. It may not have longer term had as much impact on the supply side, but investors ultimately passed that cost back on. It may have a short-term hit where investors drop out of the market as they reassess their strategy from a wealth perspective, which might, in fairness, open up the market and increase some supply in and around first home buyers. But you're right, Andrew, a lot of investors are looking at established houses, established units. You do get some investment off the plan, but that broader supply shortage in construction really needs to be driven by the institutional sector, by the internationals who are looking at rent to build solutions in high volumes.
And just before I let you go, Anthony, overall, how would you describe the investor market at the moment in housing, given where interest rates are at the moment? I mean, clearly over the past few months, many have been forced to offload their properties simply because they can't afford the repayments. What trends are you seeing right now?
Yeah, we're seeing that. We're seeing some investors offload because right now the cost to hold is creating cash flow squeezes, particularly for those with a home. The other side of the coin is we're seeing quite a bit of activity from new investors or other investors who are buying other properties, starting to see opportunities in the market, and they're looking that there's a little bit of a pocket right now, potentially before rates drop in the months ahead, which might increase activity for owner occupiers. So investors seem fairly buoyant. They're seeing that there's opportunities in the market, albeit there's a small portion of current investors who are finding it too hard to hold the property in terms of the costs associated and their personal cash flow.